Good evening, everyone. On behalf of Axis Bank, I welcome you to the 11th edition of Treasury Market Talks, our thought leadership initiative aimed at providing insight across a diverse set of tools relevant to the overall business environment. We have been honored by the presence of a number of eminent speakers, each an expert in his or her field, who have spoken their minds on topics ranging from geopolitics, central banking, and fiscal policy, just to name a few. Axis Bank has been instrumental in serving a wide spectrum of customers through its innovative financial solutions and products covering large and mid corporates, SMEs, agriculture, and retail businesses. The bank has leveraged the power of technology to provide uninterrupted services to its customers in these challenging times. Over the years, the bank has emerged as a well respected thought leader within the banking industry. The discussion topic for today is the return of inflation, and it is our privilege to introduce Professor Dr. Ottomar Issing, a storied central banker with a career spanning the transition to monetary policy as we know it today, the introduction of the euro, and the formation of the ECB. Dr. Issing is the architect of the ECB's two-pillar approach and has been responsible for the formation of the research departments at both the ECB and the German Bundesbank. Over the years, his voice has been warning of inflation and of central banks going astray by ignoring money and credit, which is part of the problem today. In conversation with Dr. Asing is Mr. Neeraj Gambhir, Group Executive, Treasury, Markets, and Wholesale Banking Products, and himself a veteran of financial markets over 25 years, spanning fixed income, foreign exchange, capital markets, structured finance, derivative, risk management, and investment banking. Some housekeeping announcements before we begin. Participation in the webinar is by invitation only. Axis Bank reserves the right to block access to any person to whom an invitation has not been sent. Unauthorized dissemination of the contents of this webinar is strictly prohibited, and prior explicit permission of Axis Bank is imperative. As a reminder, all participant viewing panels will be in the view-only mode. Participants who wish to ask questions may post them on the question box on your screens. Please note that this conference is being recorded and may involve the presence of the press or media. On behalf of Axis Bank, I once again welcome all our customers to this event. I now hand the conversation over to Mr. Gambhir.
Thank you, Tanay. Good evening and a very warm welcome to all of our customers who have joined us this evening on a very interesting topic, a topic which is at the forefront of everybody's thought process: inflation. As Tanay mentioned, we are privileged to have Professor Issing join us from Germany. His experience in setting up ECB in the initial stages of ECB, setting up the two-pillar policy of the ECB, and the initial sort of thought process with which the ECB went about, defining the policies, etc., of the euro area, and his subsequent work in this area, makes him the foremost expert in this sphere. We are in quite a bit of unprecedented times. As far as inflation is concerned, we know that the initial phase of inflation in the last 2 odd years was seen as a bit of a transitory supply shock driven by most central banks. Over the last 12 odd months, we have seen that view change quite dramatically, and central banks across the world have become very concerned about the sustained level of inflation. And inflation is no longer seen as just a supply side issue. I was reading one of the papers on Project Syndicate by Professor Issing, where he quotes a paraphrased quotation by Alan Blinder, who was the former Fed vice chairman, which says that inflation, we know that there is inflation when people are talking about inflation. We are indeed talking about inflation everywhere in the world today, whether it is the policy makers, whether it is the financial market participants, whether it's the individuals, households, corporates, corporate decision makers such as yourselves. We are all very concerned about what this inflation is going to do and how long-standing and how persistent it is going to be. I think the key question that we are trying to grapple with today is, indeed, the central banks or everyone else thought that inflation is going to be a transitory phenomena. We have now transitioned from that transitory phenomena to saying that no, it's a bit of a problem and we need to address this. We still don't know how long lasting this situation is going to be, and whether we are going to slip back into the pre sort of COVID space when deflation rather than inflation was supposed to be a challenge. To answer some of these questions, let me just quickly bring Professor Ising into this conversation and have him give us his initial remarks, and we can then take it forward from there. Professor Ising, over to you. Please help us think through the challenges of inflation as we are actually facing them today.
Thank you for the kind introduction. It's a pleasure, privilege to be with you this evening, and due to the modern technique, we are so close and at the same time so far away. I'm reminded the Mexicans are saying we are so far away from God and so close to the US. Let me start with a few introductory remarks. During the Great Moderation, a long period of low and stable inflation, continuous growth, and moderate unemployment, the risk of higher inflation was off the radar, even in central bank circles. And since inflation started above the 2% target in 2021, quite a number of central banks have been in the transitory camp, expecting inflation to return to prior low levels via self-correction, so to speak, mainly due to energy prices ceasing to rise any further, then falling again, and global potential output significantly improving. Just to give an example, even in February of this year, Philip Lane, the chief economist of the ECB, argued that, I quote, "Since bottlenecks will eventually be resolved, price pressures should abate and inflation return to its trend, and here it comes, without a need for a significant adjustment in monetary policy." This is a statement which was given by quite a number of central banks worldwide. As a consequence, central banks saw no need for action to counter the risk of higher inflation. Until the end of last year, for example, the European Central Bank even went so far as to communicate that sooner rather than later, it would once again face a situation of too low inflation, as it had experienced for a decade, by projecting inflation rates to fall below its target of 2% in a relatively short period of time. I think this was probably one of the biggest inflation forecast errors since the 1970s. Even before the Russian attack on Ukraine, central banks had to continuously revise their inflation assessment upwards. The problem of, for example, the ECB, but it's also true for other central banks, the Fed, for example, severe underestimation of inflation since mid-2021 is a deeper source. They have largely ignored that the traditional models, including those to estimate potential output, were unable to take the substantial structural changes into account. The pandemic, as a combination of supply and demand shock, entails a persistent negative shock on the output potential and is a major source of structural problems which had to be addressed by targeted and temporary measures of fiscal policy. Especially the Fed, but to some extent also the ECB, have underestimated the inflationary impact of expansionary fiscal policies via boosting domestic and global demand for goods and energy. A major deep structural change is taking place on the global level. In an important book, Gotthard Pradhan already in 2020 have analyzed the main forces which will bring a change in the international environment from a disinflationary impact to a world where inflationary influences will dominate. Demographics is a major source, but also the rise of protectionism. The Russian war and concerns about future tensions with China will strengthen the intention in all countries to reduce dependency on foreign sources of energy as well as other essential products. What are the consequences of these and other developments for monetary policy? It's hard to understand, for example, why the ECB has been remaining in the crisis mode it adopted after the financial crisis in 2007-8, and the same is true for the Fed. In Europe, even negative central banks in other parts of the world, very low central bank interest rates, heavy purchases of bonds, so-called quantitative easing, were no longer appropriate in a period when the economy was improving and unemployment very low. In the US, in an astonishing pace. Now, with inflation rates not seen during the existence of the euro, the Fed has finally reacted, and the ECB also, but very late, and still modestly. It is time that monetary policy cannot it is true that monetary policy cannot control energy prices and should look beyond temporary price shocks. Its role is to prevent inflation expectations from losing their anchor and wages profits starting an upward trend. The pandemic, war-induced military spending, other geopolitical crises, aging populations, and not least climate policy will contribute to higher public spending. This implies a strong risk that public debts, having already reached historically high levels, will increase further, with consequences for the sustainability and credibility of public finances in a number of countries. The Russian war as a negative supply and wealth shock indicates the risk that the euro area and probably the US are heading towards a stagflationary environment, with inflation still well above 2%. Plotting a way out of the crisis mode under such circumstances is a big challenge for central bankers. But as the experience of stagflation in the 1970s demonstrates, letting inflation rise unchecked is no appropriate option for central banks with the mandate for price stability. To conclude, we are living in a time of substantial change. Uncertainty, especially in the form of nitrogen uncertainty, which cannot be embedded in models, is extremely high. Policy, and here we talk about monetary policy, has to take this into account and must not rely on outdated models. I think I should stop here. This is just a framework, probably for
that's very helpful, Professor Ising. It's a very interesting framework that you kind of laid out for us. Let me just pick on a couple of areas where I thought we could actually, think a little bit more. My first point is that, in your July 16, 2021 article on Project Syndicate, you talked about a concept of regime change. There is a regime change from post GFC era. There are a whole lot of things that you talk about which might be contributing to this regime change. And I'll mention a few that you've written in the paper. For example, rising healthcare expenditures, the reduced pace of globalization, supply chain disruptions, etc. How should we think about this regime change? Do you think that is this regime change very abrupt, or is it something that will unleash upon us in a slow, steady fashion? And what does this regime change mean for the policymakers? I mean, how should they sort of start thinking about this regime change now?
Let me first say that when I joined the central bank, in this case the Bundesbank, in 1990, I made up my mind what will be the challenges for me. And one warning I gave myself was that be always aware that structures which have worked very well for the time might change and this change might go unnoticed. Bob Lucas has written extensively about this regime shift issue and has demonstrated that it has deep consequences on all kind of models, because the parameters in those models are based on past events. And when regime shift comes, then those models are not able to deal with structural changes. And as you mentioned already, I think it's not the regime shift is a worldwide one. Not only Guthrad Pradhan in their book, but many other observations, and you are in the middle of that, of course. The experience when the Iron Curtain fell in 1990, India was before already part of the world economy. China was not. Many Eastern European countries were not. The access of China to the world market had an implication of adding more or less 1 billion workers to the workforce in the world. And this impact over the years exerted a pressure on prices and wages everywhere in the world. When you go shopping in the US and you have any textiles and you see it was made in China. And now with wages increasing in China and with the one-child policy, I think there will be a tremendous change in the direction, in the quantity of the worldwide workforce, and and other factors work in the same direction. With the pandemic, with the war, with Trump's protectionism, the growth rate of world trade has substantially declined. And now, especially in Europe, Germany, we are so exposed to gas from Russia, and so many production lines are interrupted. And this has created awareness that going in the direction of producing at home, or at least in friendly countries, is the device for the future. And this will be more costly. In the European Union, unfortunately, under the French dominance, there is a strong tendency towards, I would not say autarky in agriculture. Yes, President Macron has more or less announced we need food autarky, not being dependent on the world. So protectionism is increasing. The fight against climate change will be very costly. So there will be. We have to put this in one sentence. Whereas the world after 1990 exerted deflationary pressures on prices and wages in the whole world, now this global influence will move in the other direction. So this is a deep regime shift, regime change. I think which will have strong impacts, not only on monetary policy, on fiscal policy, on all kinds of policies. So this is dramatic, and so uncertainty is extremely high because we are not fully aware what are all the implications of that. We are still sorting out. I don't know how India is dealing with this problem, but you are now in the middle between Europe and Russia, so to say, on gas and oil. So production lines, all this is totally changing. But not to be only pessimistic, we have learned that change is always a risk, but also is an opportunity.
No, I think your question about India, I think we are in somewhat similar situation as Europe as far as our energy dependence is concerned. Except that we are not dependent upon Russia, we are dependent upon a whole host of suppliers because our largest import is crude oil. And as the price of energy changes, the price of crude oil changes, it has an impact on our external finances. It has an impact on our balance of payments. It has an impact on how rupee behaves versus US dollar, which is the principal currency against which we trade. So whatever happens in the rest of the world, and as India has also integrated, while we all talk about China integrating with the rest of the world and that creating a deflationary process, deflationary pressure, we also need to be mindful that India is also integrating with the rest of the world over the last 10 to 15 years. While we haven't had as much of a deflationary impact on the rest of the world economy, what it has done is basically our integration with the rest of the world has actually created demand for us and our dependence on the rest of the world as far as energy is concerned. So I think we are equally exposed. But as I was saying before the event, that unlike the West, where most of the major economies or most of the major economic blocks were used to a very low level of inflation, right? Even before COVID and even before GFC, and GFC kind of added to that deflationary pressure. Some of the emerging economies like India have been used to somewhat higher levels of inflation. I think we are on an average about 5 to 6% inflation rate. Our central bank's inflation target is between 4 to 6%. So actually, if we go to 7, it's not such a devastating outcome for us. We are still, about 200 to 300 basis points higher than where our target is. But if you think it from a Western perspective, if you go from 2 to 9 or 2 to 8, that's a huge change, right? And that basically means that getting back to 2 is equally challenging. It's not going to be as easy as initially it was thought to be. I just want to pick up another point that you made in your papers, which is basically that expectations and the role that central banks think of expectations on inflation process. We all know that inflation is an adaptive process, right? We all know that the past experiences play a heavy influence on how people think about future inflation, right? It does feel like that central banks, particularly the Western, the developed market central banks, are still believing that expectations are unanchored. Markets are believing that expectations are unanchored. Hence, we see that, if you see the curve, if you see the forecasts of where the US rates are going to be headed, or even where ECB rates are going to be headed, everybody believes that come 2023, we should see central banks start cutting rates again. Somewhere along the line, there's a belief that inflation is going to be very temporary and central banks will be able to come back because inflations are anchored. Do you have a different view? Do you believe that expectations can become unhinged going into the future?
This is a key question. There is a library full of studies on forming expectations. So this is an issue which is studied now intensively. But I think the experience, is my interpretation, it turned out that the forming of expectations was for a long time more or less backwards looking. It's not surprising. If you have for 20 years low inflation, it's for people, even for markets, to think this is normality. And by the way, there are quite a number of young central bankers who have never seen inflation. So also for them, when I joined central banking, I entered the Bundesbank saying we must fight against inflation. Today, or let's say 2 years ago, a young central banker trained well in MIT or Harvard might enter the central bank saying we must fight against the risk of deflation. So the mindset, I think, is important. But talking about expectations of markets and people, I saw in one of your questions or remarks that you give high attention to household expectations.
That's
And
right.
of course, what matters is the change in inflation, not the level. But this is rather new. The Bundesbank has started to look more closely into households' expectations. ECB and the Fed were mainly concentrated on market expectations, etc. But I think this is sorting. It's a new sorting, and I would warn that this adjustment to a changed environment or a regime shift of expectations might not happen smoothly, but might happen abruptly. And this critical point for me is the moment, might be a period, when central banks lose credibility, when they miss on their main mission to maintain price stability, which means low inflation, low stable inflation, when the markets, the public gets the impression central banks are not able to deliver on their mandate. And I think then we might have an abrupt upwards adjustment of expectations. So this cannot be defined simply, but if inflation goes on for long, if it turns out, I'm most familiar, of course, with the ECB, if it has announced inflation will not rise, it has risen much faster. All forecasts, all announcements were wrong, were badly wrong. It's not so much about criticizing, but this is a matter of fact. It's a matter of fact. So it's, you know, the story of crying wolf.
Yes.
Yeah. So one time too much. So I think we are living in a difficult period of time, and I'm not saying that inflation will be de-anchored rather soon. I say there's a high risk. And in this context, because we are talking about monetary policy, and with the weakening of economic activity for central banks, it's now much more difficult to raise interest rates than if they had done that 1.5 years before. But in this context, I think central banks have also to be aware, and I think the Fed is, that one aspect is concentrated here in delivering on bringing inflation down earlier, because there's a risk for the credibility or reputation of the central bank.
So that's a very important point. I think in my opinion, I think the whole narrative around inflation changed when the central banks started thinking that if they don't act, their credibility will be questioned, right? I think there was a tipping point somewhere where the central bank started sort of shifting away from just thinking about growth to saying that now we have to do something, and now we have to do something aggressively to make sure that our credibility is restored. There is also a belief that, you know, if the central bank is seen to be acting, then at least the public will believe that inflation is going to come down. So there is a expectations role there as well in central bank actions. And one very interesting outcome of the GFC, and if you recall Ben Bernanke and his helicopter money days, was as the interest rates globally kind of started hitting the lower zero bound, right? Central banks came up with two innovations. One of the innovation was forward guidance, right? The whole idea of forward guidance was that we'll make the people believe that the rates are going to stay lower for longer, and that should hopefully help the long-term interest rates to come down, and that should actually hopefully help the economic activity play out, right? Do you see the forward guidance? And we know that quantitative easing is out of the window quite some time back. All balance sheets are, central banks are in the process of tightening their balance sheet. So do you see this whole concept of forward guidance also being thrown out of the window? It felt like that in this recent FOMC, Fed Chair Powell did talk about uncertainty going into the future, and you've written about uncertainty as well. So do you see that forward guidance sort of kind of...
To start with the most recent observation, it seems that the ECB has given up forward guidance.
Okay.
President Lagarde has said we will act on current data. I think this is a very dangerous approach. One should act on future data, but let that be aside. So I was very critical on the instrument of forward guidance on theoretical grounds at the moment when it started. I have a number of arguments for my critical position. One is that forward guidance by the central bank is always seen as based on conditions. Market and the public will always take it as unconditional. And I think it's very difficult to talk, but I think basically if the central bank says over a long period of time we will keep our interest rates constant and they have reservations in mind, markets will say they will deliver. And markets, I think, are probably right. Because if the central bank comes in a situation in which it would have to act against its forward guidance promise, I think it would be very difficult because it would create turmoil in financial markets. Bernanke, with this very little remark on tapering, I think this was an example of that. And for me, the key problem of forward guidance is the central bank wants to give certainty to markets, but on the basis of being uncertain itself. So this is a contradiction in itself. So we could have a long theoretical debate. I feel a bit vindicated by recent developments, and I could understand that at the zero lower bound, central banks used forward guidance as a new tool. Janet Yellen has once said, this is a revolution, forward guidance, a revolution in communication. Not all revolutions are good, I would say. And I think it has not turned out. In this case, I think it made some sense to say we will keep our interest rates longer than markets might expect. But I would be interested in your experience, which means that central banks lure you into longer-term investments. So you take a higher risk because the central bank has said we will keep interest rates low. So the risk is in those who take positions on the promise of the central bank. So this is a very dangerous arrangement, because getting out of this is punishing those who have strongly believed in very long forward guidance of the central bank. So I think for me, it was never the panacea for problems. I would be very cautious. And now with this high uncertainty, going beyond what do we know about what will be next year, take Europe, the war, etc. How can a central bank commit beyond, let's say, some few months? So would you call this still forward guidance? I think it was, for me, best communication of the central bank is we have a mandate, we are tough on delivering on our mandate, you know our reaction function. And I remember when I often gave speeches on when I was chief economist of the ECB, and the audience, people said to me, you are very open and transparent, etc. I said, I didn't say more than you should know anyway.
Right.
You have more or less the same information as me, more or less. You know, our aim is price stability. You know our reaction function. You should know what we will do. You might not know if you move by 25 or 50 basis points, but the rest is more or less shared knowledge.
No, I think, as you mentioned, I think a lot of the practices that some of the emerging market central banks have adopted of late have actually been borrowed by what the Western central banks have done. I think there has been a constant clamor from the market on our own central bank to say that please give us more forward guidance. And I think um, as the policy was very accommodative, as the need was seen for central bank to continue to support the market with more liquidity, lower interest rates, I think that was a convenient thing to do for central banks to say, hey, we are there. We will make sure that the rates will stay low. The big challenge for an economy like India is that uh, while on the one hand we have this whole issue of managing inflation, we also have a fairly large fiscal deficit to be financed through our domestic markets, right? Our 96% of our fiscal deficit is, and if I look at combined between center and the states, where a federal economy is through the domestic markets. And therefore, the central bank also feels the need to make sure that the yield curve has an orderly evolution, because in this context, the yield curve is seen as something called a public good, right? Which is basically means that it has an implication on the government's finances, it has an implication on the taxation policy effectively, etc. So I think uh, that sometimes creates a bit of a conflicting situation where the central bank may want to actually be surprising the markets. They may want to take action basis the data, but to make sure that the yield curve has an orderly evolution would warrant somewhat more stability in the policy. So in India, we have a slightly different kind of challenge to deal with in that sense. But I also noticed that Fed has actually kind of introduced this whole concept of dot plots post GFC, and I think it'll be very difficult for them to get rid of that, right? I would probably be very surprised to see dot plot actually going out of their communication policy anytime soon. So till such time that is there is some kind of forward guidance, even though they might caveat it by saying, hey, we don't know what's going to happen. We'll deal with data as it comes out. Let me just shift the gears a little bit and ask you this question: that what are the second round effects of inflation that you see that we currently have, right? What is what to your mind is the are the implications that we haven't really yet thought through, and they could actually present to us as time goes by if inflation continues to stay the way it is?
I think the critical moment of any inflationary process is when wages, profits are moving together, and inflation, based on inflationary expectations, is becoming entrenched. In Europe, so far, wages have reacted until now very moderately. But if I may take the example of Germany, when the inflation is 8%, and unions in the past were very moderate in their wage claims, union leaders cannot explain to their members it's an exogenous shock. It's an exogenous shock, which is true. The whole society is losing wealth. We have to bear that together. So you should not ask for compensation for inflation in your wage demands. This will not work. This will not work. For example, at Lufthansa, the ground workers have a wage request now of 9%. IG Metall has requested 8%. So this will not fully come through, but it shows the direction. It shows the direction. So I think it's interesting to compare the present situation with the inflationary process in the early 70s. When, for example, there was a wage round when the public service asked for 14% wage increases. For Germany, this was unseen.
Yes.
Unseen. And in the US, they have introduced a price and wage stop under Nixon, which didn't work, which is always the worst reaction, because as soon as you lift it, inflation is exploding. So I think this is indeed the critical moment here, coming back to inflation expectations. If I had many discussions with union leaders in the Bundesbank, in the ECB, and they came always to my office and saying me as a kind of enemy, insisting on price stability, which is sort of working against our interest. And I always try to explain to them it's the other way around. Once you go into wage negotiations, future inflation is a main element of the forming of your wage demands. And if you cannot rely that the ECB will deliver 2% inflation, then you are lost. Then you must make your own calculation. So this 2% is not a threat; it's a promise of the central bank to you. And here we are back to the credibility problem. I think it's in the end we always come back to credibility.
Right.
If the unions are convinced this inflation episode will be temporary, transitory, I think they would mitigate their wage demands. They would still ask for some compensation. But if they could convincingly tell to their members, you see, this is totally, next year it will be much better, etc., it makes a big difference. But for the time being, nobody's exaggerated. Not many believe in Germany that next year inflation will be again back to very low levels. So this is the dynamic of the process. We are again in a critical moment because, and then you have the example, if one union goes ahead, others will have to follow, more or less, forced by competition between them.
No, that's a very interesting observation, Professor Ising. I think we at times underestimate the sociological impact of inflation and how it can actually become a self-sustaining phenomena because of the sociological impact. I think we think of inflation more in monetary terms than the social impact it can have, and how it changes the equation between the various parts of the capital, right? The capital versus labor equation also changes if inflation does become unhinged to some extent, right? You've also sort of been a little traditional in that sense to say that you seem to be a firm believer of the fact that inflation is a monetary phenomena, right? And that's one point on which we've seen a considerable amount of debate over the last, I would say, 20 years, right? And it's not very clear whether it is or it is not. For example, the recent episodes of inflation were all attributed to supply side shocks and what can a central bank do. Here in India also we see some of that debate in a slightly different way. For example, food forms a very large component of our CPI basket. So whenever we have exogenous shocks to food supply, for example, if we have a drought or if we have a weak outcome on monsoon, we tend to see food prices actually inch up. And then you have this argument that, oh, should the central bank be actually reacting to an exogenous shock of this nature? It's a supply side shock. What can you do about it? So where do you stand in that debate? I mean, I think has it been proven in this cycle that inflation indeed is finally a monetary phenomenon?
When I was still teaching at the university, and Milton Friedman published his program for monetary stability, and his suggestion initially was to increase the supply of money steadily by 4% from year to year, even from month to month. I found this idea fascinating because it would take away with the discretionary power of central bankers. So I'm a liberal in the European sense.
Okay.
But when I presented this approach to my students on the blackboard, it worked. I very soon learned it doesn't work in practice. And even Friedman, at the end of his life, distanced himself from that. So I think over a longer period, inflation is the monetary phenomenon, a very long period. This is, for example, one of the reasons that in the 2010s following years, a number of my colleagues were predicting inflation in Europe. I did not share this opinion because relevant money, M3, for example, was rising only slowly. Central bank money was exploding.
Right.
But it remained in the banking sector.
Right.
And this is not price relevant. It's relevant for asset prices.
Right.
But not for goods prices. So when money which is relevant for purchasing goods, chasing goods, so to say, more money chasing goods, then prices rose. So there was much confusion about strong growth of money. Relevant money in the 2010s, etc., didn't rise at all. Very, very smoothly, 3% or so, like that. And by the way, it's interesting. Money growth. It's going back again. So I like more Mervyn King's. He has written, I think, a wonderful paper 20 years ago with the title "No Money, No Inflation."
Right.
Because what you have described, that wages rise, if there is no money to finance higher prices, inflation cannot materialize.
Right.
But the point is here, the causality comes from cost push, from import prices, etc. And money is an endogenous sort of development. This is not something which is in the traditional monetarist view. But I think the equation, the quantity equation shows very clearly you cannot finance higher prices without more money because velocity will not do the job.
Right.
But this leaves open what is the causality, and I think in the short period, 1-2 years, etc. The dominant factor is, let's say, wages, energy prices, etc. And if the central bank would try to keep money supply constant, we would have a deep recession.
Right.
So I think we should talk more about the causality in this context.
So that's very interesting. I think whether central banks can afford to keep the money supply constant and therefore cause a recession, it's a very expensive, outcome for everybody, particularly for the political class. And hence, whether in real life we have this luxury of sort of thinking of inflation purely in the monetary terms. I think this is a key sort of takeaway for me. One of the factors that you described was the impact of China integrating with the world, right? So it effectively provided a lot of cheap labor, and it kind of it exerted a downward pressure on the prices. And now we're clearly seeing, because of the new geopolitical configuration, there is a lot of rethinking on that, right? Both at the political level. We've heard recently that US is now asking some of the chip manufacturers not to set up factories in China. It is also becoming a boardroom discussion as to where should you have your production capacity. And I think it's possible that some of the production capacity which would have gone earlier in China would probably go back to more expensive locations, even if it's US or UK. What role does this have in the entire inflation story? I think is it, in your opinion, is it a very longer lasting phenomena that will play out, or do you think that it's a transitory thing?
I think in this context, the power of unions will increase. Because in the past, employers have told them, if you demand too high wages, we will outsource our production to wherever, China or other countries. And this was always more or less even dominating the wage bargaining process in many countries, US included. And this pressure will more or less disappear. So I think we will have also in this respect a regime shift, that union power was declining in the Western world since the last 30 years or so. And with labor becoming more scarce, and with also, you mentioned, and economists tend to underestimate that sociological aspects. There's a backlash from this period of weak labor force. So this all contributes to, I think, a change in wage bargaining processes. I think in all countries. It's already visible in Germany now, also with a new government. This is true for other countries too, Italy, France. Macron is under much more pressure from the left than he was in the last term. So I think this is also part. If I were younger, had more resources available, I would like to write a book on this change in the global economy, even the mindset. It's not just economics, prices and production. It's much broader. It's much broader. It's much broader. And so I don't know. I was told that if in China somebody says to you, we wish you to live in interesting times, it's a curse.
It's a curse.
It's the same true in India?
Well, we always attribute it to Confucius, who's a Chinese philosopher, but yes, it is very well-known phrase in India as well.
So we live in interesting times.
We live in interesting time. On that note, I think we've kind of hit our time limit for the conversation. There are a bunch of questions that we have from our audience. So I'll ask Tanay to sort of go to the Q&A.
Thank you, Professor Rising and Mr. Gambhir, for that, for those insights. I'm putting together a number of questions that are along similar lines. It broadly says, so inflation now has become something of a supply side phenomenon. What good are interest rate hikes in managing inflation? Is that the correct tool to use to combat the supply side inflation? I mean, I'm aware that inflation expectations will come down and so on and so forth, but does it not risk credibility getting even worse over time if inflation does not come down over that period?
I think I have talked a lot about this risk that inflation might become more entrenched in our societies. But I agree with you saying inflation is a supply side phenomenon. With energy prices, etc., especially rising. But it's at the same time a demand side problem. I think it was most visible in the US when a person like Larry Summers, I exaggerate a bit, for whom the deficits could not be high enough in the past, warned strongly against this huge package. And he said this is the most irresponsible macro policy he has seen in his lifetime. He referred to the demand side. And in the US, I think this demand side factor was even stronger than the cost push factor, because the US had not so experienced so much increases in energy prices because they are oil producer themselves, etc., much less dependent. But in the US, it was at least, I would say, to the greater part, a demand side issue because of this high supporting programs. But also in Europe, it was underestimated that in the pandemic, fiscal policy reacted very intensively with supporting industries, households, etc., putting a lot of money into many sectors, and this translated in demand for products, etc. So one should not underestimate the demand side problem. So central banks cannot say we are totally not responsible for this development. It's just cost push. I think this is too simple, and it's not true. It's not true. But in the direction of a stagflationary environment, of course, for central banks, it's much more difficult. And here I cannot miss the situation of saying what makes me really angry is that central banks have missed the opportunity to get out of this crisis mode much earlier. The Fed still had huge amounts of quantitative easing underway when the economy was already booming. In Europe, unemployment was at its lowest level in history since the euro area. The ECB still bought massive quantities of bonds, mainly from governments. So I think there was a lot talk about not going the restrictive direction too early. This was the wrong expression. There was a need to get out of the crisis mode, which was introduced after 2007-8, and in Europe after the euro crisis in 2012. At that time, it was appropriate to react massively with easing monetary policy. But this crisis mode was continued until quite recently, 2 years ago only. And to have such low interest rates in Europe, even negative interest rates, with many negative side effects, I think this was, for me, was irresponsible. And now it's, of course, much more difficult because in here you are fully right. Supply factors came on top and play a major role, but one must not forget the demand side factor.
Thank you, Professor Essing. The next question is again by a few people, but I'll name HPCL and the Motherson Group in this question. So what they say is geopolitics are very volatile. Starting from Brexit and then the Ukraine war and China and Taiwan, you're having formerly unthinkable things happening on a regular basis. This obviously affects prices, price formation, macros, and could possibly make inflation more volatile. Do central banks themselves get more volatile in terms of the rate cycles then? Or how should one handle things?
Reminded me that I forgot in my long list of factors which contribute to the regime shift Brexit, which is for Europe and with the close relations to India, also probably for you as an indirect impact. For Europe, it was a kind of turning point because since the start of the common market, it was always more integration with more countries, still countries waiting before the door of the European Union. And then, not suddenly, the UK was always half in, half out. It's a typical British behavior. A typical British behavior. They wanted to have all the advantages of being in, but being sovereign at the same time. And this didn't work. And the reason why Margaret Thatcher had once a long discussion with her, why she it's interesting to remember that Margaret Thatcher was, as being a market-friendly person, strongly in favor of the single market, because this means more competition, open, free markets. But when it came to the question of having a common currency, she said, no, this goes into our national sovereignty and we will never join on that. So this was always kind of Damocles sword over the British participation. But a good friend of mine, member of the House of Lords, when voters decided that the UK should leave the European Union, he sent me his speech, a short speech which he gave at the House of Lords. He was jubilating. He told me, now we will be free from the yoke of Brussels. I said to him, dear Geoffrey, I hope you are right. But if I look in your past experience with economic policy, I'm not so convinced that you will be. I hope you will present an example of market-friendly economic policy which will exert pressure on the European Union to go in the same direction. But looking at your history, I'm afraid something else might happen, and one day you might desire the time when you were under the yoke of Brussels.
So, Professor Singh, the question was volatile macros, volatile inflation. So, do we also have volatile interest rates from central banks?
Yeah, I was taken away by by this issue because I've worked on that and discussed with so many people in the past. So I think this is you point to a very important aspect. We talk about almost only about the level of inflation, but you refer to the volatility of inflation. And I think great moderation showed low and stable inflation. But the aspect of inflation has also a lot to do with the stability of the inflation rate. A constant inflation rate will more or less, the industry markets will adapt to that. But if inflation rates are volatile, it's much more difficult. I hesitate because when I see you, gives also an opportunity for you to make money. If it's boringly stable, so to say, one source of chances for making money
Is gone.
Is gone. It's gone. But from a macroeconomic point, of course, we want to have low and stable inflation. And I think the risk, I don't think that Brexit has much to do with that. But the volatility of inflation might be an aspect which we might experience over the next years. Because what we will see, but this is now more or less driven by cost push factors. We will, I think, experience now a period when energy prices stop to rise so fast, and this will have already an impact, bringing inflation down. But at the same time, other sources of energy might become more costly. So it will be, I think, much more difficult to predict inflation even over for relatively short periods of time. So I would say yes, inflation volatility is a matter of concern.
And if I may add to that, Tanay, I think the one thing that we should be mindful of is the length of the cycles. I think it's quite possible that if inflation becomes very volatile, the central bank easing and tightening cycles could become a lot shorter than what they used to be in the past, right? And we might have far more frequent switches between an easing cycle and the tightening cycle. So I think that remains to be seen. I don't know if inflation is going to be very volatile going forward, or is this just an episode and we'll settle down later? But if it is, then we need to be prepared for far more volatility in the central bank's regimes themselves.
Absolutely, I fully agree. And here credibility comes again back. if central banks, if inflation expectations become re-anchored, strongly re-anchored, I think this will reduce volatility of inflation to a large extent.
Thank you. Mr. Gambhir, there is a question for you from T. Venkatesan of TCS. I'm rephrasing it, but to what extent must the RBI chase the Fed in terms of rate hikes? If the Fed does, say, 75 or 100 more, is the RBI forced to do 50 more, or can we, confident in our own macros, be able to do whatever we think fit domestically?
It's a very difficult question. I think, history has proven that um, the integration of the markets, right, the mobile capital, has effectively made all central bank policies, zero in or anchor in towards each other quite strongly, and Fed being the lead sort of monetary policy maker. Uh, Given the fact that we run an open capital account, we have kind of um, floating currency. Um, it will be very difficult if we see a very rapid increase in US interest rates or US policy rates, and that causes a large amount of capital outflows for us. And we are therefore forced to contend that large outflow of capital by way of higher interest rates, even though our domestic economic situation doesn't warrant us to have that higher level of interest rates. For example, as I mentioned, the the distance between the current inflation rate and our target inflation rate is, let's say, about 200 basis points, whereas in US it's about 600, 700 basis points. So US needs to do a lot more. Doesn't mean that we also need to do a lot more. That may be the starting point, but if we see a large amount of capital outflows, that might push us to have a more than warranted higher level of interest rates to make sure that the currency doesn't come under threat. So I think that's the conundrum. There is no easy answer to this conundrum. We need to see how much of this reversal in Fed policy. We've already seen a very large amount of capital outflows out of India and many other emerging markets. We need to see how much of that outflow continues and whether the current level of reserves that RBI has are sufficient to protect against that outflow. I think at this point in time, I think the size of the reserves that we have acts as a big cushion in terms of us chasing, what Fed is doing or RBI doing exactly what Fed is doing. But if Fed were to continue to hike interest rates beyond what is priced in the markets, I think that would pose a bit of a problem.
Thank you, Mr. Gambhir. I have a question that befits Professor Essing's decades of experience in the markets. Inflation targeting began only in 2002 formally, with the Reserve Bank of New Zealand giving an inflation target. But before that, things were far more variable. How would central banks have reacted to this sort of situation in the 1990s, for example? How would you have reacted in the 1990s if you were there and this happened?
I think the history of inflation targeting, which started, as we know, in New Zealand, and it was a total success over time. Almost all central banks joined the camp of inflation targeters. And there's an interesting study by John Taylor, who has worked out the fact that when, let's say, more or less all relevant central banks in the world have the same inflation target of 2%, or in some countries higher but stable, then this should also contribute to stabilizing the international exchange rate system. And I think this is a factor which plays a major role. So the idea of John and others, and I to a large extent share that, if most or all relevant countries have the same approach of inflation targeting with more or less the same target of roughly 2%, then you introduce a stabilizing factor into the international monetary system, which is very important, because in the past in the past, major exchange rate crises were caused by very different inflation rates. The US presented this case when they were financing the Vietnamese war with inflationary public fiscal spending. And I remember at that time, the exchange rate of the DM was fixed against the dollar. So the Bundesbank has just to buy the inflowing dollars, just blowing up the domestic money supply. So I think inflation targeting has not also contributed to keeping inflation low and stable, but has also contributed to more stability in the monetary system. But this is now also at stake because we might have experienced quite different inflation numbers in a number of countries, and as you have discussed it before and explained with what consequences it has also caused very different levels of central bank interest rates. So I think we are again in a situation which is far away from the very rather smooth development we've experienced over now 20, 30 years.
Thank you, Professor Rissing. I forgot to mention this was from Nitin Parikh of Hindalco. If I may ask, can I take one more question? I know we're beyond time. It's an interesting question, and it goes, why haven't settlements shifted to other currencies? What does the USD and the euro have that the CNY or a basket of emerging market currencies don't? Why is there still dominance of these currencies in the market? And this goes to both of you, Professor Rissing and Mr. Gambhir.
You might know professors always quote themselves. So my first book was on the international monetary system and the role of key currencies. The key currencies, I went back to medieval times, but I will spare you this part. So we know that after the First World War, the dollar took over the leading position from pound sterling, which still played a role in Commonwealth countries, etc. But the British pound has expired as an international currency, more or less. It's now coming back a bit, but not much. I think the history of key or leading currencies demonstrate that only a currency which huge domestic financial markets with strong position in international trade, with credibility in political and money terms, is the basis for getting in this leading position. For the US, on top, the Bretton Woods meeting in 1944 made it, so to say, official. The dollar was established as the anchor of the whole monetary system of fixed exchange rates. Over time, the US more or less started to destroy this position, but then flexible exchange rates, when Nixon declared in 1971, the dollar would not be more convertible for foreign institutions into gold. Then we had this period of very high volatility in exchange rates. But the experience history also shows that the incumbent, in this case, the US dollar, is in a very strong position. We have network externalities, etc. If the dollar, for example, plays a major role in invoicing oil exports, etc., then you need also in banks reserves in dollars, etc., in foreign exchange markets, etc. This is all reinforcing all the elements which make this position of the US dollar more or less intangible for some time to come. When the euro started, especially the French The French always wanted to put the dollar as the leading currency into question. De Gaulle in the 1960s, when the dollar for central banks was still convertible at a fixed price of $35 into gold, presented all its France's gold reserves to the US, destroyed, and asked the Germans to do the same. To convert its dollar reserves into gold, and this had been the end of this position of the dollar. But the Germans, for many reasons, political reasons, military reasons, did not join. But when the ECB started, the French desire to create at least a strong competitor to the dollar was present again. And as the chief economist had a quite tough fight with this idea, and finally the ECB, I think it was my position, and I more or less was successful in this direction. My position was we should not neither foster nor hinder the emergence of the euro as an international currency. For me, it was a market-driven process. If we present a stable currency, many central banks in the world will put not all their eggs in the dollar basket, but also have reserves in euros. And initially, the euro's share was rising to 25% of foreign exchange reserves. Now it's 20%. But the dollar share has declined somewhat in the direction to 60%, but it's still by far the most dominant currency in the world, and this will not change for some time to come.
Yeah, I'll just add to what Professor Ising said by saying that there are multiple factors that go in deciding a international currency. Political power obviously is the most important factor in my mind. I mean, dollar became. The World War II did not end till such time US joined World War II, right? As long as it was a European war, it was just progressing for a long period of time. So participation by US was an important element in bringing the World War II to an end, and therefore established US political power, and hence established the the dollar's hegemony in the world financial system. I think for a currency like Chinese yuan or even Indian rupee, I think there are many other conditions that need to fit in. For example, first of all, we need to be a fully convertible currency, which neither of the two are at this point in time, right? Second, that a lot higher participation in the world trade in some senses, which probably is true for China, not yet true for India. I think we are still a significantly smaller part of the world trade. And then you need to have a network of financial institutions across the borders. I think that condition probably is more true for India than it is for China. So I think there are these factors which are still evolving for these two major economies before we can start claiming some kind of role in the global markets as a reserve currency. Till that time, I think people will focus on US dollar, euro, or maybe to some extent Japanese yen as the main currencies.
I think, in my interpretation, I'm not a political scientist. Recent development in China, more inward-looking to say the least, I think works against this ambition of the Chinese to make the renminbi leading currency. At the same time, we can observe that the US is increasingly using the dollar as a kind of weapon. Think about the sanctions against Iran, now sanctions against Russia, which will increase intentions by other countries to create their own area, so to say. And this is very dangerous for the US because its strong position was based on open markets, etc. Take, for example, if the Saudis one day could dare to invoice their oil exports not in dollars, this would have dramatic consequences for the position of the US dollar. So the politicization of currencies will be an issue, and for the time being, it's not extremely dangerous, but it's undermining the strong position of the US dollar.
Tane, I think we've massively overshot our time.
Yes, I'm just.
Yeah.
Thank you, Professor Rissing and Mr. Gambhir. That was an extremely interesting discussion. What we don't often get is a historical context that goes back as far as you've described it, and it was really enlightening to listen to what you were saying. And these are relevant, especially given that we are now once again in flux in terms of regime change, as we spoke about before. Thank you. We look forward to all our customers joining us soon for the next edition of our Treasury Markets Talks. A recording of this call will be available in case you wish to have this passed on to your colleagues. Do connect with your relationship managers for any assistance in this regard. Once again, thank you all for joining us. You may now log out from this call.
Thank you. Bye-bye.
Bye.